So some stories about clients that we work with. And these are IBC Global clients. The one thing about these, we have changed the names to, of course, protect the innocent. So starting with Mark. He started a whole life insurance policy with a lump sum of about $75,000. Today, he adds about $7,500 per year to his policy, and he took a policy loan to make a down payment on a home for him and his family. That's how he used his policy. Next, we've got Tim. So Tim has an 8-figure real estate portfolio. It's valued a little bit more than $25 million. And he's got several policies, 4 to be specific. And what he does is use the cash value in his policies as a line of credit to purchase more property and also for property improvements. Then we've got Mary, who we've worked with for a very long time. So she's a real estate agent and investor. Her income fluctuates. Sometimes she has really good months, other times not so much. So how we set her policy up is in a way where she only commits to about $10,000 per year. That's the minimum she pays, which does not feel like a burden to her. However, she can put up to $100,000 per year into her policy. She'll regularly take policy loans for her real estate investments, and she's got a fixed loan rate at a little bit more than 5.5%. Then we've got Mike, who I've known for a while too. He invests in commercial real estate. Now, he got to a point in his life where he was just tired of working with banks and hearing a bank tell him, your line of credit has been cut in half because the market's changed. He's like, I'm not dealing with this anymore. I'm just tired of it. I want to be able to move quickly. So what he decided to do is get some very large whole life insurance policies, and he uses the cash value literally as his own bank or his own source of financing. Now, he funds his policies aggressively with about $600,000 per year, but I will add, he didn't start there. He started much, much, much smaller than that and has built up to that dollar amount as the years have passed. So, why do real estate investors put money into whole life insurance? A few reasons why. Number one, my cash value is guaranteed to go up over time, no matter what. Number two, a lot of times we hear them express that they don't trust banks or they're just tired of working with them. Number three, it's extremely convenient. I can easily access my cash value. I can do it through my mobile app, online portal. It's simple. Point four, when I access the money, my money keeps on compounding. And point five, it's tax-free. Real estate investors that we work with tend to always care about the cash value. What we hear the most is I don't care about the death benefit. Why I'm interested in putting a lot of money into this life insurance policy is because I want to see my money grow, being the cash value, and I want to be able to use it for real estate. So with the cash value, there are 3 core benefits that I like to call them the 3 core benefits. My cash value grows safely. I can access the money while it keeps on compounding, and it's got a nice tax benefit, meaning it's tax-free if the agent sets it up correctly. That second point though, that's what most folks are interested in. I can access my money while it keeps on compounding. What does that mean? What it means is that your money is going to keep on earning interest even though you take it out of the policy. So I can earn 5% on my cash value in the policy and then take that same money out while it keeps earning 5% and use it for real estate. I can do that? Yes, you can do that. Now, does anything else work like this? Or is this too good to be true? There is something else that works like this. Real estate. Let's go through an exercise. Let's pretend that you own a piece of property that's worth $100,000. We'll assume that it's a perfect world and the fair market value of your property goes up by 5% every single year, no matter what happens in the marketplace. Sound good? All right. After 1 year, it'd be worth $105,000. 2 questions. If you own that property outright, meaning there's no loan on it, Does your property value still go up by 5%? Question number 2, if you have a mortgage on the property, does your property value still go up by 5%? The answer to both questions is yes. If your property is worth $105,000 and you say, I'm going to sell it, it doesn't matter if you have a loan outstanding on it or not. If you have a $50,000 loan outstanding and you sell it for $105,000, the bank would get $50,000 and then you would get the remaining $55,000. The thing is, I can use the money that I have in real estate while it keeps on compounding. So if my property is worth $100K, it appreciates by 5%, I take the $50K out and use it for something where I can get 10%. That's where real estate investors leverage existing property that they have. Whole life insurance works the same way with some added conveniences. So how does it work? Let's recap. Step 1, I get a whole life insurance policy. 2, I don't get it for the life insurance, I get it for the cash value. 3, I take loans to buy real estate. And 4, I know that my money keeps on compounding when I take those loans. Make sense? All right, let's look at step 1. How do I get the most cash value possible on day 1? This is what's most important to real estate investors. Getting as much cash value as possible. And the reason why is because they want to be able to use that money for real estate. I don't want to take an upfront hit on my money. Otherwise, I might as well just keep on putting it into real estate. Another item that's important is flexibility. What this means is I don't want to get a big premium bill every year. Let's hit on the first point first. How do I get as much cash value as possible? We're going to go through an exercise. This will be similar to what we looked at with Doug the doctor earlier. So we're going to look at the same insurance company and the same insurance product. Here's a whole life insurance policy. Let's pretend this is you. Would you like options A, B, or C? You're paying $10,000 per year for 10 years. That's a total of $100,000. Here's the options side by side. Which one has the most money? A, B, or C? It's a lot of information. Let's look just at the first year. Option C, significantly more than the other two. How about the 10th year? Option C. 20th year? Option C. See what's going on here? 30th year? Option C. That's the only option that cracked $300,000. And again, you paid in $100,000. Option C gives us the most money. Why though? Because if I'm a new consumer learning about cash value life insurance, what I just looked at was the same insurance company, the same insurance product, and I paid the same $10,000 per year for 10 years. Remember that chart we looked at in the beginning? Blue, red, and green? What was in red, those two terms? Premium and PUA rider. This has everything to do with getting as much cash value as possible. So first, we've got the premium. When I get a life insurance policy, what I am doing, especially up front, when I put money into the premium, I'm prioritizing the life insurance piece first and the cash value piece second. Whereas the PUA rider, which stands for paid up additions, I like to call it a cash dump-in, easier to remember. This will prioritize cash value first and life insurance second. Let's look at option A. I'm paying $10,000 per year. In red, what do I see? My full $10,000 is going toward the premium. What's going toward PUAs? 0. As a result, my cash value is $300. Not very attractive. Let's look at option C. I'm paying the same $10,000. What's in that column in red? $1,000 per year. What's in that light blue column? $9,000 per year. Same out of pocket of $10,000 per year. What's the difference? $8,700, almost $8,800 in cash value immediately. Option C has the most money because we minimized the insurance premium and maximized the PUA rider. We juiced the cash value. Option C has a base premium of 10%. 10% base premium, 90% PUA. We like to call that a 10-90 split, meaning we're splitting how much goes toward premium and how much goes toward PUA. That's how you get the most cash value on day one. And when we look at long-term policy values, it also produces the most long-term, not based on illustrations, but based on actual results of policies that we've seen. Flexibility. So if you picked option C that had $10,000 per year going in, how much do you think you're going to get billed for every year? 10 grand? Your commitment, or what you are billed for, is $1,000 per year. Everything that goes into PUAs can be added at your discretion. Quick story about Adam. I met Adam back in 2018. He's a real estate investor. He also works as a mortgage broker at a bank. His income does fluctuate. Now, when I connected with him, he had a lot of money in cash and he wanted to fund a whole life insurance policy with $120,000 per year for 5 years. Here's the thing though. He was really stressed out about the idea of getting a bill for 120 grand per year. So he had an amount he wanted to be able to pay in, but that full amount and writing a check in February of every year, that's his premium anniversary date, he's like, nope, that's not going to work for me. So here's what we did. We set the policy up where he's billed for a little bit more than $13,000 per year, and then he can add up to $120,000 at his discretion. Make sense? Want to see his actual policy? So here's what actually happened. So I met him in 2018. He started his policy in 2019. You'll notice that he's paid in for 6 years. The plan was to pay in for 5 years, but he wanted to keep on going because he's liked how it's performed over the years. So he pays in $120K per year. First year, he's got 105 and change. That's the worst year of any whole life insurance policy. If you ask, what's the drawback to this strategy? That's it right there. The first year, I take a hit on my money, and it takes some time to make up for that hit. So he gets his money back between 3 and 4 years when I look at this. So the upfront hit, that's the drawback to any whole life insurance product, no matter how well it's designed. Now, quick side note about what Adam did. He took a loan from his policy in 2023, last year, for about $500,000 to use for real estate. And again, he works for a bank. You may have caught that when I mentioned that earlier. Why he's using his policy is because the interest rate with his policy is more attractive than what he gets with the bank that he works for. And over time, his cash value just keeps on growing. So, what should I do if I want a whole life insurance policy for cash value? Well, step one, maximize the cash value. Kind of a no-brainer. Make sure I have as much money as possible. Step two, make it flexible. Speaking of step two, let's look at step two of our guide, policy loans, what you need to know. So how we're going to hit this section is we're going to look at a case study of a real estate investor who's going to fund his policy for 5 years, never pay another penny into it after the 5th year. And what we'll look at is purchasing a property for $300,000, and what we'll review is his money, specifically the cash value and the impact on it. So let's look at the policy first. He pays $100K per year for 5 years. After 5 years, he pays $0. Year 6, which is the first year he pays nothing, he's 50 years old. His cash value is about $535,000. His death benefit is $1.8 million. At 58 years old, if he just lets it ride over time, his cash value is $755,000. And in this example, the death benefit's still 1.8. Eventually that begins to increase. Okay, that's letting it sit and grow. Here's what it looks like if he borrows against it. So we're going to take a $300,000 loan to purchase a property. We can take loans anytime we want. We can typically take them as early as 10 business days after we start a policy. In this example, we did it after he pays into it because it's easier to follow the charts this way. So he takes a $300K loan. Before we look at paying it back, let's look at the impact that it has on the policy. The cash value and death benefit went down. The cash value is $218,000 and change. It reduced by $300K, plus it's accounting for the loan interest that's due. The death benefit reduced by exactly $300,000. It was 1.8, now it's 1.5 million. Now he's going to start to pay the loan back. He doesn't have to in this example, but he wants to. So he's going to pay it back at $50K. In purple, we see how much is applied to the loan principal, and in light red, we see how much is applied to the interest, and in dark red, you see your loan balance going down, 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 until it reaches zero. Okay, so a lot of numbers there. Here would be my question. What does my money look like after I pay that loan back? Because this is the whole thing, like why people do this. Here you go. At age 58, cash value, $755,000. Death benefit, $1.8 million. Do you remember those numbers in the example where we just let it sit and grow? Is there a difference? No. They're exactly the same. Here's what happened. My money kept on compounding by 4 to 5% within the life insurance policy, even though I borrowed that money and went out and used it for real estate. So I also earned a return on my real estate with that $300,000. This is how people use cash value life insurance to buy real estate. Make sense? Cool. That was step 2. Step 3, know your numbers. What is my cost to borrow?